All right, let's talk about crypto, but let's cut through all the noise for a minute. Forget the hype, forget the memes. We're going to dig into how you can build a crypto portfolio that's actually based on something real, something you can measure, and hopefully something that's built to last. Let's dive in. For a lot of people, this is the fundamental question. The whole space can feel like a wild casino, right? Where it seems like it's just pure luck. But what if it's not? What if there's a way to step back from the chaos and use a clear, logical approach to find projects with real long-term potential? And that's exactly what we're here to do. Our goal is to shift our focus away from pure speculation and instead zoom in on the fundamentals, solid technology and actual real-world use cases. This isn't about guessing the next 100x coin, it's about learning how to spot enduring value. So how do we even begin to navigate this world? Well, you need a map, a compass, and for us, that compass is going to be a simple but really powerful framework. We're going to call it the 3 pillars of value. This is going to be our guide for everything else we look at, helping us separate the real substance from all the hype. Okay, so here they are, the 3 pillars we're going to use to evaluate pretty much any crypto project. First up, is the tech actually solid? And more importantly, is it secure? Second, are real people and businesses actually using it for something meaningful? And third, is there a healthy, growing community of builders around it, a real, vibrant ecosystem? Let's start with that first one, the absolute foundation, technology and security. Look, a project can have the most amazing idea in the world, but if its technology is weak or easy to hack, it's basically like building a skyscraper on sand. It's just not going to last. In this game, being reliable and resilient is everything. And if you need any proof of why security is so critical, just look at this number. $2.17 billion. That's how much was stolen in just the first 7 months of 2025. This isn't some theoretical thing. It's a constant, massive threat. So a secure foundation isn't just a nice to have. It's the absolute bare minimum for any project worth considering. So next up is adoption and utility. Once you've confirmed the tech is solid, the next question is, so what? Is anyone actually using this thing to solve a real problem? We're not talking about abstract ideas here. We're talking about real, measurable economic activity happening on-chain. And here's what that looks like in the real world. As of early 2025, there was over $131 billion locked into the Ethereum ecosystem. Now, that's not just some vanity metric. That number represents immense trust. It means that real people and huge institutions feel confident enough to put a massive amount of capital to work on that network. And that brings us perfectly to our third and final pillar, ecosystem maturity. See, for a project to truly last, it needs more than just cool tech and a few early users. It needs a thriving community, especially developers who are constantly building new things. And most critically, it needs to have a real business model that can generate actual, sustainable revenue right there on the blockchain. And this is already happening. Take a look at this finding from 2025. It shows that mature ecosystems like Solana are generating a huge chunk of all on-chain revenue. What this tells us is that they've moved beyond just hype. They've built genuine, self-sustaining digital economies where people are willing to pay for services because they provide real value. Okay, so now we have our framework. The theory is great, but let's actually put it to the test. Let's take our 3 pillars and apply them to 2 of the absolute titans of the crypto world, Ethereum and Solana. This is where it gets really interesting. The first thing you've got to understand is that these 2 have completely different philosophies. Ethereum is all about being modular. Think of its main layer as a super secure armored highway. It's incredibly safe and decentralized, but not the fastest. So all the high-speed, low-cost traffic gets routed onto separate connected networks called layer 2s, which are like express lanes built on top. Solana, on the other hand, is monolithic. It tries to do everything at once, be the super secure highway and the lightning-fast express lane, all on one single layer. And that fundamental difference in design has a massive impact on performance. You can see it right here. Solana's all-in-one approach gives it this incredible raw speed, handling thousands of real transactions every single second. Ethereum, when you combine its main layer with all those layer 2s, also achieves some really impressive speeds, but it just gets there in a completely different way. So this table really just lays out the trade-offs in black and white. In one corner, you've got Ethereum. It's the king of decentralization, commanding the market with that massive $131 billion in value locked in. In the other corner, you have Solana, the speed demon, with transactions that cost less than a penny, which is why you see huge institutions like JP Morgan building on it. It's really that classic battle. Do you prioritize maximum security and decentralization or raw speed and super low costs? Okay, so that's a lot of analysis. The big question is, what do we actually do with all this information? How does this help us build a real investment strategy? Well, let's walk through what a balanced, moderate risk portfolio with a 5-year horizon might look like. This is where the rubber meets the road. So, here's one possible way to structure it. You could anchor the portfolio with a solid foundation, 25% in Bitcoin, the digital gold of the space, and another 25% in Ethereum, the dominant platform for smart contracts. That's your core. Then, to get some of that high growth potential, you could add 15% in Solana. To balance things out and reduce volatility, we'll allocate 15% to stablecoins. Think of that as cash on the sidelines. And that leaves us with a final 20% for some more targeted strategic bets. Now, let's zoom in on that 20% strategic niche slice, because this is really important. This isn't just about throwing money at random small projects. It's about investing in the critical infrastructure of this new economy. So maybe 7% goes to a layer 2 like Arbitrum. That's a direct bet on Ethereum continuing to grow and needing those scaling solutions. Another 7% could go to an Oracle network like Chainlink, which is basically the data pipeline that connects blockchains to real-world information. It's absolutely essential. And the last 6%, you could put that into foundational DeFi apps like Uniswap or Aave, the literal heart of the on-chain economy. Now, before we wrap up, we absolutely have to talk about risk, because building a portfolio based on fundamentals is a massive step forward. But let's be real, it does not make you bulletproof. It is essential to go into this with your eyes wide open to the challenges. You can pretty much break down the risks into 4 big buckets. First, security risk. Hacks and exploits are a constant threat. Second, regulatory risk. Governments are still figuring this stuff out, and a new rule could change the game overnight. Third, technology risk. The pace here is just insane, and today's leader could be tomorrow's history. And of course, there's market risk. You have to be prepared for some seriously extreme volatility. And check out this detail from a Chainalysis report, because it's so important. It says that nearly half of all the money stolen came from a pretty simple cause: compromised private keys. That tells you that security isn't just about the network itself. A huge piece of the puzzle is individual responsibility and making sure you are practicing safe ways to store your assets. So, let's end on this question. If we start applying a disciplined framework like this, one that focuses on real technology, real adoption, and a real ecosystem, does that change the entire game? Maybe long-term success in crypto isn't about having a crystal ball to predict the future. Maybe it's just about having the discipline to stick to the fundamentals. Something to think about. Thanks for tuning in.